Okay, let's get started. Welcome everybody. Thank you for joining us today. My name is Sean Moss with Down Payment Resource. We've got a few other speakers and some teammates in the background here. We are with Down Payment Resource. Many of you have been to our website in search of down payment assistance programs. Many of you have attended some of our recent webinars that we've been hosting for consumers, prospective home buyers. This is part 2 of our Path to Homeownership series, where we're going to break down the role and the value and the expectations of the loan officer in your homeownership journey. And my name, as I said, is Sean Moss. I oversee operations here at Down Payment Resource. I work a lot with banks and mortgage lenders that use our technology to help find out about and tell you about and work with down payment assistance programs. And we're also going to be speaking today with Tamara De La Cruz, who is on our team as an HFA relationship manager. An HFA is a housing finance authority. So Tamara works with the housing agencies all over the country that provide and fund and offer down payment assistance programs. So we can keep that information up to date in our system and bring it to you guys through our website at downpaymentresource.com. So the two of us are gonna, we both have some background in the lending world as well. So we're very familiar with these programs, the role of the loan officer, the team that the loan officer builds in support of you as a home buyer. And we're going to talk a lot about that today and kind of break down the loan officer role. Our company, Down Payment Resource, has built a database of all of the home buyer programs around the country for down payment assistance, closing cost help, tax credits, and more. So you guys joining us today are all over the country. These programs are available all over the country. Every state has a state housing finance agency. There are local housing finance agencies that offer down payment assistance. There are cities and counties and nonprofits and other organizations that offer all kinds of down payment help for prospective home buyers. We'll give you some resources here at the end, but basically our goal and our mission is to raise awareness of all of these down payment assistance programs so that those of you considering or exploring home ownership, you don't delay because of down payment concerns. There are programs out there to help you overcome the down payment obstacle, and we'll talk more about that as we go. I do want to be clear, we at Down Payment Resource are not a mortgage lender. So we are not here to pre-qualify you today. That's not our role. We are a technology company. We track and monitor all of these down payment assistance programs all over the country to bring them to the forefront for you as you explore home ownership. But we are going to talk about the role of the loan officer in the mortgage portion of your home ownership journey here. Now, this is part 2 of our Path to Homeownership series. If you were on our last webinar 2 weeks ago, we had a housing counselor. We spoke to them about the role of the housing counselor. It's a great starting point, a preferred starting point, and they work on your behalf and give you objective guidance and advice and referrals and counsel with regard to housing, home ownership, and your journey towards home ownership. Today, we're moving on to part 2, step 2. Which is working with a loan officer, getting pre-approved, getting pre-qualified, getting the financing set up, and preparing you basically for going out and shopping for a home and so forth. We will have, it's a 6-part series, so we will have 4 more webinars every 2 weeks for the next couple of months. The next one in a couple weeks, we'll talk about mortgage options. We're going to break down mortgage programs specifically, their down payment requirements, mortgage insurance, picking the best option, advantages and disadvantages of certain mortgage programs. Now, obviously, the loan officer plays a critical role in that, and we're going to break that down today. But then the next webinar, we'll discuss mortgage options in particular and in detail. Then from there, we'll move on to homebuyer education and the relationship between homebuyer education courses, often required for down payment assistance programs, and your home ownership journey. And then we'll get into the real estate agent. A lot of people start with a real estate agent, but in the path to home ownership, there are some things that should be done prior to working with a real estate agent, shopping for homes, and signing a contract. And then we'll wrap it all up at the end with what successful home ownership looks like, what happens post-closing. After you get the keys and move in, what are some of the things to expect? So today, part 2, we're going to break down the loan officer. What we're going to cover specifically is how to and with whom to finance your home ownership journey. We're going to talk about the role of a loan officer, understanding loan terms. We're going to talk through and walk through the mortgage process and the people involved and the steps involved and some of the expectations for you to be mindful of. And then we'll talk about what are the next steps toward home ownership once you've done your upfront work with your loan officer, and where to go from there. Now, we want to start with a poll today. So we've also got Melinda Harris in the background and Fern White. They're both on our team. And Mel, if we can go ahead and launch the first poll, and then I'll introduce Tamara and we'll get started here talking about the loan officer. So tell us where you are in your home buying journey. Now, you may be at several stages here, but which of these most accurately reflects where you are in your home ownership journey? Are you just thinking about buying a home? Did you see this webinar and think, well, maybe I'll give it a shot and see where I am or see what happens? Maybe you've been browsing homes online. Maybe you're warming up a little bit to the idea and you're starting to look at properties. Are you or have you been talking with a housing counselor? That would be another critical step. For some of you, maybe you're working with a loan officer already, working on your loan documentation, getting your mortgage set up. So farther along in that process, maybe some of you have already done that and you're working with a real estate agent or perhaps even under contract for a home. So tell us where you are in your home ownership journey, and we'll share the results here. But all of you here are here today because you're at some phase in the home ownership journey here. So, all right, a lot of you are just thinking about it. A lot of you have progressed to looking for homes online. That's good. That's good. For those of you that have been talking with a housing counselor, that's a great first step. And as we covered in our last webinar, that's somebody who works on your behalf, objective perspective. They're going to give you sound guidance and advice and counsel and set you down the right path. They'll look at credit, budgeting, and so forth. For those of you working with a loan officer, that's good. You're going to hear some familiar things today. Hopefully you take some advice out of this that will help you navigate that mortgage process. For those of you that are past that, looking for homes, you've done a good job so far. Keep at it. Make sure you've got your down payment covered, and that's been discussed with your loan officer. And hopefully you get some tips and tricks out of this today, or tips and best practices. All right, so let's close that out. And Tamara. Now, I apologize, guys. I didn't actually officially introduce Tamara, but Tamara, say hi to everybody, a little bit about your background, and then let's talk about who a loan officer is.
Hi, everyone. Happy to be here, and I'm happy you folks are here. My background is 25 years, basically, in real estate and mortgage. So I've done everything. Whatever there is to do, I've pretty much done it. So hoping that you guys can get some really good information out of this.
And I myself, just so you guys know, have been a processor, I've been an originator, I've worked in the mortgage business for almost 20 years. So you've got a lot of experience here talking to you about the role of a loan officer, but we're going to loop in some of the other people. So specifically, Tamara, let's just give everybody kind of a basic definition. What is a loan officer? What do they do? And who do they work for?
So a loan officer is the person who works for the lender, the institution that's going to provide the financing for the home that you're going to purchase. So the loan officer is there to provide that financing. And as far as who they work for you. So the loan officer is somebody who works for you as the borrower to make sure that you're getting what you need. And they're there to make sure that you fully understand all aspects of the transaction and what it is exactly that you're going to be getting as far as fees and as far as what you're going to be paying. Go ahead, Sean.
Well, I was going to add, and they're there to help you get set up on the right mortgage for you. And we're going to get into what that might mean. But they're there to help you navigate the mortgage options that are out there. There are a lot of different kinds of mortgages out there, guys. And for those of you that have gotten that far in your process, you've probably heard, okay, should I go FHA? How much down payment do I need? We'll get into all that. But they also work with a team. So Tamara, let's talk a little bit about who the loan officer has as part of their team. What are some of the other people that a borrower, a home buyer, our audience should expect to work with as they start to work with an LO and start to go through the mortgage process?
Okay, so the person that you're going to probably work the closest with outside of your loan officer is going to be your loan processor. The loan processor basically takes all the information from the loan officer, puts it all together, packages that information so that they can send it to an underwriter to review. So your processor is going to be the person who's probably going to be reaching out to you the most throughout the transaction.
Yeah, and as you go, keep in mind the loan officer is going to set everything up front. They're going to work with you on getting the product right, getting all the initial documents right that you have to sign. But once it gets to a processor, that's really your champion. That's who you're going to hear from most frequently. And we'll come back to this later. That's who you need to be in touch with and respond to. When the processor reaches out because they need something or they have an update, answer that phone, answer that email, get them what they need, because they're the ones that are going to keep everything moving along from, upfront loan document disclosures all the way to closing. And if they need something, it's because an underwriter asked them and you need to get it back to them and keep the process moving here. So you've got your loan officer. That's the upfront person. They're going to set up your loan. They're going to work with a processor. That processor supports the loan officer, takes those loan applicants, progresses them through the pipeline. They're going to be doing a lot of stuff in the background. The processor's doing some stuff in the background while they're working with you. And we're going to talk a little bit more about that when we get into kind of the loan process here. But your loan officer will get you set up. You need to be mindful of the fact that the processor is going to kind of carry you through to the end point here. But so the loan officer gets you set up front. But how do you find one? Which one do you talk to? And if you haven't gotten that far yet, pretty soon, as you're talking to a housing counselor, the idea or the topic of finding a loan officer is going to come up. So Tamara, let's talk about a few places where somebody might find a loan officer referral. What are some good ways to go about doing that?
Well, as Sean pointed out, when you talk to your home ownership counselor, a lot of times they're going to know loan officers who participate in down payment assistance. So that's always a good place to go. You also could talk to your bank. You could talk to your credit union. There's many different options out there that you could talk to kind of get an idea of what they have to offer, as well as the DPA participating lenders, and we'll get into how we can find those.
Yeah, and if you go to your bank, if you go to a credit union, you're going to get a banker, and they work for that company. That company has their products. You could also look at a mortgage broker. A broker, just like if you went to an insurance broker for your auto insurance or something like that, the broker is able to price options across many different lending partners they work with. So there can be advantages to either, right? If you go to a credit union, you pay for membership, and part of what you get are great service, great rates, great deals. Your bank, if you want to check out your bank that you bank with for checking, savings, and so forth, they may have some mortgage options for you. They've got loan officers. You can check with the broker. You might want to check with some of your friends or family that have recently purchased a home or maybe recently refinanced, and they worked with a loan officer to do that. That can be a great way to get a referral. Ask around, see if anybody's done anything like that recently, and if they enjoyed their experience, maybe they've got a loan officer they would refer to you. Likewise, if you're a Costco member, for example, they have mortgage benefits and some of the other membership clubs like that. Or if you're a member of a union, there are a lot of different paths through which to find a loan officer. If you know a realtor or have worked with one in the past, or maybe you're in communication with one now, you can even ask them. They work with loan officers all the time too. As far as lenders that participate in down payment assistance programs, we want to be clear about that, because a lot of you came to this webinar because you've been on our website looking for down payment assistance programs. When you do a search for down payment, that's DPA, by the way, down payment assistance. When you do a search at downpaymentresource.com on our website, we show you the programs available based on your inputs, location, household size, income, estimated purchase price, and so forth. We show you the programs after you complete your search, but one of the things that we show you are links to the list of lenders that participate in that program. And those are lists that are published by each program provider. And in that manner, you can find lenders that offer that particular down payment program and will likely offer others as well. So that's a great way to make sure that you're finding lenders that offer and participate in down payment assistance programs. Now, one last thing here, Tamara, let's talk about comparing options. So we basically just laid out there are many paths to find a loan officer. Is it okay? Is it acceptable? Is it beneficial to compare options or shop loan officers?
Upfront, yes, because you don't know, everybody has sometimes different rates or different things they can offer. So yes, just like you would go get a second opinion from a doctor or a mechanic, go get a second opinion or a third opinion from a loan officer. But this is something you obviously want to do up front. By the time you get into finding a house and getting into contract, you really want to have your loan officer picked. You want to have somebody chosen. You want to have your team solidified, because you don't want to be really, unless there's something absolutely that happens through the process, you want to stick with one loan officer. But definitely upfront, find out what options are out there, because this is a huge purchase. So it's okay to shop up front.
Yeah, that's a great point. As you progress through your loan process, one thing you really want to do is, to the best of your ability, and your loan officer and processor are going to be working on your behalf in the same manner, you want to reduce the number of things that could delay this process. Your real estate agent ultimately will be helping to do this as well. So anything you can do to make sure there are no delays, and we'll talk about some things to avoid, but one of those things is, do all that comparison, do all that shopping, interview loan officers up front, get a feel for their products, their interest rates, your personality fit with them, and so forth. And once you've made that selection, hopefully all the things that need to be vetted up front were done, and stick with them. Because again, we don't want to create delays in this mortgage process, especially right now, guys. You hear more about bidding wars. That means there's not much inventory out there for sale. We're not in a market where, there's a lot of inventory that would be called the buyer's market, where you've got a lot of what am I trying to say? Authority. It's a seller's market. The sellers hold the advantage right now because there's so little inventory that many buyers come to one property and try to compete for the best deal. So especially in an environment like that, you want to get all that stuff worked out up front, shop your loan officers up front, go through these different channels, figure out the best option, then stick with it and work with that processor as well. Now, we're going to get into loan terms, the kinds of terms that you might hear when you go apply for a mortgage. But the first thing we wanted to tackle was, what is the difference between a pre-qualification versus a pre-approval? So Tamara, just kind of big picture, what's a pre-qual?
Well, a pre-qual is basically where a loan officer is going to take a mortgage application and maybe do, get all of your information, maybe do a soft pull on your credit to see a range of what you may qualify for.
And then versus a pre-approval, now that goes a significant step forward. So a pre-approval is going to be a full financial review. You're giving bank statements, W-2s, pay stubs, maybe even tax returns to your loan officer. They're looking at the mortgage product. They're looking at your assets, looking at your down payment requirements, maybe looking at down payment assistance programs. But Tamara, what comes out of the pre-approval that you don't get with the pre-qualification?
Well, when you have a pre-approval, you actually get a pre-approval letter. And so you get something in your hand that you can then take to your realtor and tell your realtor, listen, this is what I'm pre-approved for. This is how much house I can buy. This is the interest rate I'm looking at. And then that gives you a really solid ground then for your realtor to be able to show you some property. And you want to make sure that you have that, because a lot of times a realtor won't want to show somebody property if they don't know for sure they can afford that much house or what their qualifications are. So having that pre-approval is very important.
Yeah, that's a great point. That's what the realtor's looking for. And they may not want to take you out looking for properties unless they know you've been through this process with a loan officer, because they want to know that you're mortgage ready, you're ready to go. If you found that property, they want to be able to write that contract, and you got to be pre-approved to get that done. So that's why we have the loan officer ahead of the realtor in this webinar series. You really need to get this mortgage process done, get pre-qualified, get that letter in hand, and go to your realtor and say, okay, done, got it, approved, let's go look for a home.
And just to add another point, let's say you go and you find a house and somebody does work with you. When you write a contract, the other agent, if he's a good agent working for the seller, he's going to want to see a copy of that pre-approval. He wants to be able to tell his sellers, hey, this person's solid. They've gone through this process. This is a good deal. So it's not only your realtor that will ask for it, but more than likely the seller and the seller's realtor will want to see that also.
So the difference between pre-qualification is that sort of a cursory review up front to get a feel for what your price range might be and what your payments might be. Pre-approval is a credit pull, financial review. You've submitted your income and your asset documentation to an LO. They've looked at the right mortgage product for you. You've got an interest rate. You've got a mortgage ready. They've looked at down payment requirements. You've got your down payment assistance program lined up if you go that route, and you have that letter in hand. You go out to your realtor, and then you start shopping for a home. Now, we mentioned down payments. We're actually going to cover this in a lot more detail in the next part of our series where we dig into mortgage options. But there are a lot of misperceptions out there about down payment requirements. We hear all the time that prospective home buyers think they need 20% down to buy a house. You don't. That's just flat out wrong. So if that's what you're being told, you're being misinformed. And I'm gonna go to Tamara here in a moment, but there are low down payment mortgages all over the place. And these aren't like subprime mortgages. They're not bad loans. If you've heard of FHA, I mean, that was essentially created for first-time home buyers. Great product. There are some great conventional products. But Tamara, walk us through, the actual real down payment requirements for some of the common loan options that are out there, especially for first-time home buyers.
Well, as we talked about, FHA, 3.5%. Of the purchase price is what you're going to need for FHA. Now, conventional is where a lot of misconceptions are. A lot of people think, like Sean said, you need 20% down for conventional, but you can get a 95 or a 97% loan, only needing to put down 3 or 5% for down payment. So you don't need a full 20%, as Sean brought out. And then if you're looking at, obviously, with VA, a VA no is, no money down, and USDA, you don't need to have any money down either. So you don't need as much money as you thought. And with down payment assistance, that's got you covered right there.
Yeah, and that's what we do at Down Payment Resource. We track all of these down payment assistance programs, which can be used to meet these minimum down payment requirements. But Tamara, let's clarify a couple things. One, we say 3.5%, 3%, 5%. Of what? What does that mean?
Well, you're going to take 3%, 3% or 5% of the purchase price. And that's how much you're going to need for down payment. That is what's considered the minimum requirement that somebody needs to put down in order to get that loan.
And then let's clarify VA and USDA. VA is Department of Veteran Affairs. Those are 100% loans. You don't have to have a down payment for qualified, eligible veterans of the armed forces. That can be active duty, veteran, sometimes reserve guard. But then USDA, let's explain that too. That's not available everywhere. It's certainly not in metro areas, but how do you get a USDA mortgage?
Well, USDA is more in the rural areas. So those are in some areas that are maybe considered unincorporated, but different areas that are maybe outside of the metro area, and you can be able to get loans there too.
And in that case, the property is the driver. The property must be identified as rural and eligible by the U.S. Department of Agriculture. All right, so those are some basics about down payment. But like we said, the next webinar in this series is going to dig into that in a lot more detail. We'll have a special guest speaker for that one. So let's talk about the mortgage process for a moment here. Let's walk through, Tamara, like we talked about pre-qualification and pre-approval, but let's say you've got your pre-approval letter. What happens from there? Let's walk through the process.
Okay, so you've got your pre-approval letter. You take it to your realtor. Realtor shows you some homes. You fall in love with one, write a contract or write an offer. You're going to write an offer, and let's say the seller accepts it. So now you've got an accepted offer, and now is the time when the loan officer comes in and gets you set up. So once you get in what's called once you're in escrow, you're under contract, then the first thing that you're going to get are initial disclosures from your loan officer. Those initial disclosures are going to go over your fees and your costs, and the different disclosures that maybe are required by the state or required by the program. So your initial disclosures are going to be the first things that you get. And those could come from the loan officer, or they could come from the processor. But once those initial disclosures are all signed and returned, which you guys need to do very quickly, then you move into the process where you've agreed, yes, I want to proceed with this loan. And now you go in, and the processor usually takes over and will contact you and let you know all of the documentation that they're going to need to be able to package that loan properly so that it can go into underwriting. So as Sean said before, when your processor reaches out to you, they're going to be your BFF. That's who you want to deal with besides your loan officer, the whole transaction. If they're asking you for something, they'll explain it, but you can pretty much guess it's because they've been doing this a long time. They know what is needed. So that's when you're going to get them all of your income, your bank documents, anything else that they ask for so that they can submit to underwriting.
Now, one point of clarification, those initial disclosures, whenever you get disclosures, absolutely get them signed as fast as possible. But we want to be clear, read them. You do need to read them. Okay, make sure your name is spelled correctly. Make sure your birth date is correct. Make sure your social security is correct. If you do have a contract on a property, look at the address. Make sure that's correct. Read those disclosures, but also do it as soon as you can and keep everything moving along and keep that processor informed. Remember, the processor is going to take that loan from the loan officer and they're going to push it through the pipeline. They're going to keep that moving forward for you and with you. When we get to initial approval, you've got a contract. Before we get to final approval, so Tamara, what's kind of in the middle? What might happen after underwriting and what's going on in the background?
Okay, so in the process, while the processor's packaging everything up and it goes over to the underwriter, in the background, they're pulling transcripts, your tax return transcripts. A lot of times they're going to be pulling a WVOE, which is a written verification of employment, to verify, the employment that you have. They're going to be ordering the appraisal. There's a lot of things going on in the background. They pull fraud reports, things of that nature. So that's all happening while the package is in underwriting. So when the package comes out of underwriting, there are so many different things that go into it. When an underwriter gets all your documentation to review it, they're going to have questions. There's going to be other documentation they need. They're more than likely going to need letters of explanation about things. Maybe you've had a couple jobs, okay, and maybe there's a gap in there. Just explain that. What they see deposits into your checking account that are the same every single month. Okay, well, what is that? Is that a debt? Explain that. You're getting child support. Okay, can we get documentation for that? You were just recently divorced, or whatever it is. There's going to be questions, and they're going to need to have documentation to be able to have in their file so that they can underwrite the file properly. So the big thing to understand is you give documentation up front, you're going to give more documentation. It's normal to do that. When you get that initial approval, it's going to say your loan is approved. It's conditional approval. It is approved based on these conditions being fulfilled. And your processor will go over all those conditions and all of the documents that they need from you, but also from the loan officer or from the appraiser or whoever it is. So just be prepared. You're going to need more documentation after it comes out of underwriting.
Yeah, and ask questions too. It's okay to call the processor and ask questions. Call your loan officer and ask questions. Your loan officer is not out of the picture just because they've handed this off to your processor to get it through underwriting, get all of your conditions. But that processor, just so you know, is in the background, excuse me, verifying employment, verifying rental history, making sure the property's not in a flood zone. They're doing a lot in the background. And also when they call on you again, it's because they need, a letter, a bank statement, a W-2, whatever they need, get it to them quickly because they're your champion, keeping the ball rolling here and keeping everybody organized. All right, so we talked about the process. Let's just briefly, and we need to maybe pick up the speed here a little bit, but let's briefly talk about some of the mortgage terms that you guys are going to hear when you're going through this mortgage process. You'll start hearing some of these things up front with a loan officer. We've kind of hit on this, but Tamara, loan to value, LTV, let's define that.
Well, that's how much of a loan you're going to get compared to the value of the house. So loan to value is like we said. So if you're putting 5% down on a conventional loan, then that means your loan to value is going to be 95%. So how much of the loan is going to be compared to the value?
Yep. So it's essentially your loan amount divided by the sales price ultimately. What about debt to income, DTI? What does that mean?
Well, your DTI is basically, okay, you make this much money, but your debt is this much. So it's how much debt you have compared to how much money you get a month.
That's an important
explanation.
Yeah, that's an important qualifying factor. So your loan officer might talk about that up front. The amount of mortgage you qualify for is a factor, but also the other credit or installment debt that you have, car loans, credit card bills, things like that. Now that doesn't mean, your insurance, your Netflix bill, your cell phone bill, those aren't included, but the things that are on your credit report, credit cards, car payments, student loans. And actually, I want to pause here on student loans. If you have student loans, that doesn't mean you can't get a mortgage. Please don't delay talking to a housing counselor or a loan officer just because you have student loans. They just need to look at the scenario and figure out, okay, well, what could you afford if you bought a home? And how does that work with your student loan payments? So don't let student loans prevent you from exploring home ownership, please. Private mortgage insurance, we'll get more into that in the next webinar, but basically that's another fee with your monthly payment that covers the lender in the event of a loss. You'll hear PMI or private mortgage insurance, or MI would just be mortgage insurance. We'll talk more about that in the next webinar. FICO, credit, that's just your credit score, basically. You'll hear it called FICO or credit score. The loan officer is going to pull credit, and they're going to figure out, they're actually going to pull your credit from all three credit bureaus, Experian, Equifax, TransUnion, and they're going to take the middle score of the three. And then escrows. Tamara, let's hit on that real quick. What's included in escrows? So you got your mortgage, and that mortgage has an interest rate on it. That's principal and interest that you pay on the mortgage loan. But what's included in escrows?
Well, your taxes and your homeowner's insurance. So your property taxes and your homeowner's insurance are also included, which come out to PITI.
And so property taxes, obviously you got to pay that bill every year. But what escrows allow you to do is break up that tax bill into 12 equal payments, and you pay it monthly with your mortgage. Your mortgage company will keep that in an escrow account, and they will actually pay the tax bill. Whoever ends up servicing your loan, we'll talk about servicing later, but whoever ends up servicing your loan, collecting those monthly payments after you close on your home and you move in, they're going to keep an escrow account, tuck away that tax payment you make monthly, and then when the bill comes out, the tax bill from your county, they'll go ahead and take that money out of the escrow account, pay the tax bill, and then you start paying in for the next year. Same thing with your homeowner's insurance, the insurance you get on the property that you buy. And then, of course, you've got interest rate and APR. The interest rate really is just, it's the rate you pay to borrow the money that you get for your mortgage. So right now, we're around 3%. That's historically seriously low, which also means you can buy more house because lower rates are lower, or you can afford the house at a lower payment that you want because interest rates are low. And then Tamara, you got an easy way to define APR?
Oh, so APR basically is the total amount that loan has cost you, with all the fees and everything figured in. That's not just your interest rate, but it also includes the cost of that loan to do, all of the fees included in that. And that's about as easy as I can get.
Yeah, so when you see, it's important to remember the interest rate is the rate you pay monthly on your mortgage, but you will see APR. It will be a higher number. It basically bakes in all the fees that you pay, processing fee, tax fee, title fee, closing fee, because you're going to close with a title agency or a closing attorney. It wraps all that together and then divides it by the price. So it looks higher than the interest rate. Just know that the APR accounts for the fees to close. And guys, you got to expect there's going to be a few $1,000s in fees. That's part of getting a mortgage. But APR will look higher than the interest rate. The interest rate is what you're paying on your mortgage. All right, now we want to ask a quick question here, and then we're going to get into what not to do. So you're along your path to home ownership. Melinda, if you can go ahead and load the poll here. What should you not do while pursuing home ownership? And you can multi-select here if you want, but go ahead and click your answers on the screen. Should you not buy a car? Should you not charge your credit cards anymore? Should you not change jobs? Should you not pay your bills? Should you not open a credit line at your favorite furniture store? Should you not talk to a housing counselor? There are some do's and don'ts here. And as you get into the largest purchase of your life, we want to also talk about the things not to do. So click your answers on the screen here. We'll give you a couple more seconds, and then we'll share the results. And then we'll have a little dialogue about this. And then after that, we'll get into Q&A here, because it looks like everybody's got a lot of questions here. So, all right. So let's share the results. So you're all right, all of you. Definitely don't buy a car. And listen, if the tires are going bad, if you need an oil change, we're not saying don't fix your car. We're saying now is not the time. If you want to buy a home and you go buy a car and you've got a $300 a month car payment now, guess what? That's $300 a month that you can't buy a home with. That's an extra bedroom and bathroom. That's a shorter commute, living closer to work. That can make a big difference. If you go get a car loan right now, right before you buy a home, suddenly the car payment is included in your debt to income ratio, and you can afford far less house because now you've got to cover that car payment. So if you can hold out, get into the house, and then explore the new car. But the house is the priority here. It's the biggest transaction you're going to make. Focus on the house, delay the car, fix it if it needs to be fixed. We're not saying drive an unsafe car, but don't go buy a car right now. Likewise, don't charge your credit cards. Okay. Once you get into this home ownership journey, you should be thinking about, chipping away at that debt. Certainly don't charge your credit cards, especially if you don't have to. Back off on the expensive coffee and eating out and those things. And your housing counselor, if you go talk to one, they'll have a plan. They'll put a plan in place for you about where you can cut expenses and get that budget right. If you don't have to change jobs, don't. And that, look, if you have to, you do it, right? You do what you have to do to take care of yourself and your family. But we're trying to avoid hiccups. We're trying to avoid obstacles here. Keep paying all of your bills. Keep paying your rent. Keep paying your credit cards. You don't want a missed payment to show up in the middle of a mortgage transaction. That's going to cause problems too. Don't go buy your furniture. Wait till you move in. Don't go charge any new debt. Don't open any new credit lines. Once you start down this mortgage process, stick to it. Focus on the house. That's the priority. The other stuff can wait. Get your house. And then definitely do talk to a housing counselor. They'll help you, cover your or review your income, expenses, and so forth. So that's good. Let's actually get into some of this. So we wanted to ask the question just to get everybody thinking about it, but some things to avoid. I'll start off with the adjustable rate mortgages. Right now, interest rates are so low. You probably want a fixed rate mortgage. Get a fixed rate 30-year loan. That interest rate will never change. The thing about adjustable rate mortgages is they're often fixed for a little while, maybe 1 or 3 or 5 years, but then they start to adjust based on how the market is behaving. Well, interest rates are as low as they have ever been in history, so they can only go up, right? It's, maybe there are some scenarios where an adjustable rate mortgage or ARM makes sense for you. We would say right now, given where interest rates are, get a 30-year fixed rate. Don't think about adjustable rate mortgages. They can only go up, and that's just paying down the road, increased monthly payments. But Tamara, we mentioned a few of these. Walk us through some other things not to do, and how did we come up with this list?
Well, we basically came up with this list because my time being a loan officer and a processor and an underwriter, these are the things that I've seen happen that can just totally derail a transaction. So definitely don't go buy the car. Don't charge your credit cards. One thing you have to remember is that they pull your credit up front, folks. However, there is something called a soft pull that happens before you go to sign your loan docs. And so what that soft pull looks for are any new inquiries, any new debt So don't think, okay, they pulled my credit once, I'm all good. No, they're gonna check. So any inquiries that come up, you have to explain. If any new credit lines show up, it has to be added to your debt to income ratio, and that can make or break a deal. So just make sure that you continue to pay your bills, but you don't open new credit and you don't make big purchases until after you're done closing. So no going to Ashley Furniture and getting a credit line. Wait until you're done, and definitely don't switch jobs unless you absolutely have to.
Yeah, and your loan officer is likely going to talk to you about a lot of this stuff when you get to that point in the process, but we wanted to bring it up now today because for those of you that are just thinking about home ownership, like from that first poll that we asked, if you're just thinking about it or you're starting to browse homes online, start thinking about these things too. If I want to buy a home, I'm going to have to wait on, the things that you need once you get there, the grill, the lawnmower, the furniture, all that stuff can wait. Get the home first, guys. Keep your priorities straight. Get the home first. All right, so let's wrap this up. We got a lot of questions. We'll stick around and answer as many as we can. But final takeaways, talk to a housing counselor. There may be some small fees there, but they're going to give you objective guidance. They're going to walk you through credit budgeting. You can look at the recording of our first webinar in this series and learn a lot more about a housing counselor. Get pre-approved. Discuss down payment options. Use our website. Go to downpaymentresource.com and look for down payment assistance programs in your area. And then, Tamara, I'll let you cover the last couple here, Homebuyer Ed and LO and the processor.
Yeah, so you want to go through homebuyer education. If you do any kind of down payment assistance program, more than likely it's going to be a requirement anyways, but it is absolutely good information to go through. They provide you a certificate that you can then provide to your loan officer and your down payment assistant HFA. You also want to make sure you keep your loan officer informed. Okay, if you're going out of town, if something's going to happen and you need to pay this or pay that, whatever is going on in your life, you need to think of your loan officer and your processor as family for that period of time. Keep everybody updated as to what's going on. Don't be afraid to talk to them. They're there to help you solve the problems because they want you in that house as much as you want you in that house. So just make sure you keep everybody informed of what's going on.
All right, guys. So that hopefully, now we know this was 30, 35, 40 minutes. We know this is quick, but we wanted to give you as much information as we could in as little time as possible. We realize also it's a Friday. Many of you are at work. Thank you for joining in. Our next session in this series will be about mortgage options. We're going to dig into conventional, FHA, VA, USDA. We're going to talk about mortgage insurance, interest rates. We're going to talk about the differences, how some mortgage products can be better than others and the benefits of certain mortgage products to help you with that first conversation when you talk to a loan officer. That's going to give you some deeper insight into the kinds of mortgage programs out there, and you'll be better informed, better educated, and better prepared to have that conversation and to stick up for yourself, quite frankly. So that's going to be 2 weeks from today, Friday the 28th at 12:30 Eastern. We're going to do it again on a Friday. We've got a few Saturday options mixed in, but then we'll continue on with Homebuyer Ed, the role of the real estate agent, and then post-closing, once you move in, what are some things to know and expect? So, Melinda, Fern, what's going on in Q&A? And for everybody that has to go, thank you for joining. We're going to answer some questions here. You can reach out to us at info@downpaymentresource.com if you have questions afterwards. And you can go to downpaymentresource.com and search for down payment help, closing cost help, tax credits available in your area. So, Melinda, Fern, what's going on in the Q&A?
Hey, Sean, sorry, I was answering a question. What a great group we've had. I honestly have not seen a lot of, we've had so many amazing questions. I haven't even really seen a trend. I mean, everybody's asking such good questions. I do want to remind everyone one more time, this is being recorded. We're going to send out a follow-up, hopefully today, Monday at the latest. That will include the recording, so you guys can revisit the information and then contact us with any additional questions. But I mean, honestly, Sean, I'm just going to keep answering in the question pane unless Fern has something. If you want to just start going down, they're still coming in. And we've just had some great questions. I think you and Tamara could speak to them.
Yeah, I see one here. I see a couple about a car. When we're talking about don't go buy a car, if you've like one of them said, okay, they're in year 2 of their car loan. Well, that's fine. What's going to happen is you're going to be qualified based on what's on your credit report today. So if you're paying on a car loan already, that's fine. That's going to be incorporated into your debt to income ratio. And after that, they're going to show you, okay, well, this is how much of a house you can afford. So having a car loan, the majority of us have car loans. So that's not a problem. What we're saying is if you don't have a car loan now and you go in and you're now under contract, don't go buy a car while you're doing this process, because then that's going to add a new debt that wasn't already there when you got your loan approval. Okay, so if you already have a car payment, that's fine. That's just going to be it's going to be taken into account for your DTI. Now, if I'm purchasing in 6 to 9 months, can I purchase a car now? That's going to be up to you. I think if you're looking at purchasing and, you'd like to, purchase a car and a house, talk to a housing counselor. Let them help you figure out whether or not you can afford both. And, what, if you could afford what your payment maybe should be for a car. So, but those are the two that I saw that kind of jumped out the page for me.
Yeah, I'm seeing a couple other questions about cars. And to that point, if you're 6 to 9 months out on a house, and Jamila asked a question too, my engine went bad in my car. Look, take care of you and your family. That you got to do that first. What we're saying is if your car is fine, the car is the second biggest purchase most of us often make, right? But if you're trying to line up the biggest purchase, which is the house, try to avoid any new debt, try to avoid any new monthly payments if you can. If you can't, hey, look, you got to take care of business, right? We're not saying don't buy a car if you need a car. If you're 6 to 9 months out from buying a house and you just want a new car, we might suggest wait it out. Get the house first. That car down payment money, put that on the house. The monthly expense, go use that to qualify for the house that you truly want. So, we're not saying don't take care of business, take care of business. But if you can wait, don't make big purchases like a car. Let's see, we got some questions here about student loans. So what's the best program for high student loans? So Shanta, congrats, by the way. I presume you graduated. You say you have a 0 payment. That might be because you recently graduated, or maybe it's in forbearance right now. There could be a lot of ways that could play out. What we would say is talk to a housing counselor, figure out what the scenario is with the student loans. When does the payment start? What will that payment be? Look at income now, projected income, and so forth based on your profession. And, just have the conversation. Student loans are not a disqualifier. It's okay to have student loans. You can still buy a house. It's just that they're going to have to account for the student loan payment, the debt, and so forth, and figure out, okay, if it's in forbearance or something, or if it's been deferred, then when does that end? And sometimes they may not have to count that payment right now, depending on deferral or forbearance. So, as far as what's the right program, mortgage or down payment program, that's really a conversation that needs to be had with a housing counselor and ultimately a loan officer to figure out what your options are. I also see a question in here from Alita. What about paying off a loan? I recently paid off a loan in full, not realizing it would cause my credit rating to drop because it's treated as an account closing. Well, 2 things. Paying it off is not closing it. However, closing, this is a great question, actually. We didn't cover this and what to avoid. Talk to a housing counselor and a loan officer first before paying down or paying off accounts, because they may want to strategize about where to do that, which ones to pay off. But it's good advice not to close those accounts. Now, if that was like an installment loan, a student loan, or a car payment, when you pay it off, it closes automatically, right? But if it's a credit card, paying it off is different from closing the account. You can pay it off and leave it open, and it still shows up as an open, active credit line on your credit. Closing that credit line reduces the amount of credit available to you, and that's a big factor in your credit score. So I would talk to a housing counselor and or loan officer before starting to pay off debts, because they may want to, like I said, strategize about which one is the right one to pay down or pay off. And they may say, you know what, let's do this one over here. They may say, let's wait, use that for down payment. You qualify with the debt. So there's a lot of different paths that can go too. But let's see.
Hey, Sean, there's one about the pre-approval letter. How long is it good for? If a person does not decide on a home within a certain period of time, will another pre-approval letter be necessary?
That's likely. Tamara, what's a standard timeline for pre-approval letter?
Typically, you're going to see it for 30 days. So, you know, if it's going to be longer than that, then you probably want to get the pre-approval letter updated. But yeah, if you need to, it's not really a hard thing to do to get it updated.
Yeah, and that also goes back to the point about keep paying all your bills. Make sure you're paying everything, because if you do have to go get another pre-approval letter, you don't want to miss payment on a credit card or something like that. You know, keep everything running just like it was prior to that first pre-approval letter, because if there are delays, maybe you don't find a house in 30 days. You know, maybe it takes longer to find the house that you want. There are a number of things that could delay, you know, your closing or even getting to the right property. So keep everything paid. Don't get any new credit, because like we said, they're going to do another pull. If you have to redo the pre-approval letter, they're going to pull credit again. You don't want new credit. You don't want bigger debts. You don't want new debts, and you don't want missed payments. I see a few questions here about credit score, minimum credit score approved for an FHA. What's the lowest? You know, how do you get a mortgage with lower credit? FHA, I guess the standard is sort of 580, but in a lot of cases you can go below that. You might need some letters of explanation, document certain, you know, unique circumstances and so forth. There's not really one answer. So let's see, if you've got a lower credit score than that, again, talk to a housing counselor. They're going to help you figure out the plan to get that score up, what needs to be done, paid down, paid off, and so on and so forth. And sometimes it might be that, you know, maybe you do need to get some new credit and work through that for a year. But again, a housing counselor will help you get through that. Fern, Mel, Tamara, what are you seeing that you want to address?
Well, I have got, I see a couple of questions here. Pat Jennings, let's see, the company I was working for paid me using a 1099 for 1 year. The next W-2, will this be difficult? Well, you know, not necessarily. If you can show, you know, a 2-year work history, then that's what that does. You know, they're going to ask you probably for a letter of explanation. Why were you paid for a 1099 here? Were you working as a temp? A lot of people start off their jobs working for a temporary company. Then they become an employee of the company they're working for, and then they get a W-2. So, you know, they'll be asking for a letter of explanation, but it doesn't necessarily mean that you're not able to get a loan. Not at all.
Yeah, I see a few about switching jobs too. You know, look, like we said, if you have to, take care of you. We're not here to tell you don't do you, or don't take care of you, or don't take care of your family. That's always your first priority, right? But you know, one from Pat, should I seek another career now? I don't like the field I'm working in. You know, that's your call. We can't answer that for you. That's a personal decision. That's a professional decision. That's between you and your family. You know, if I guess it's probably not appropriate for us to suggest anything otherwise. You know, if you could hold out and get pre-qualified and get in your home, you know, that's great. If you need to switch jobs, and look, let's be clear too, and Tamara, chime in on this. Just because you switch jobs in the middle of a mortgage transaction or your home buying process, it's not that disqualifies you for a mortgage. You can still get a mortgage. We're just saying if you can prevent any delays or obstacles or hiccups in that process, then, you know, it'll be a more seamless experience. But Tamara, anything to add to that?
Well, you know, and agreed. So sometimes things happen, or, you know, hey, you got an offer for a much better job. You know, you're going to get paid more money. If that, you know, if that new company can provide you with an offer letter, then, you know, that's something you would provide then to your loan officer. And maybe that opens up the door for you. But what we're saying is anything that happens during the transaction, obviously, changing jobs is going to put a little bit of a delay on closing on the loan, right? Because now we have to go out and have to verify the letter, the offer letter or whatever. It's not that it's going to kill the deal, but you just don't want to do anything that's going to delay it. But if you get an amazing offer, by all means, if that's something that's going to work for you, then just make sure you're going to get the documentation as quickly as possible on that new job to provide to your loan officer.
Yes, I see a couple more about changing jobs. What if you get paid more, which decreases your DTI? Hey, that's great. You know, nobody's going to tell you not to go get a better job that pays you more. That's great. And if you can get that debt to income ratio down, you're even better off, right? You're just going to have to document the new job. Maybe you get if you're in there for a few weeks, get a couple pay stubs. They're going to want to see those. So maybe the offer letter up front, and then if you're starting literally mid mortgage process, you know, they're going to want to see the first pay stub or two from the new employer, and that's fine, guys. It can be done. We're just saying, you know, if you can avoid any potential hiccups, then try to do so. But always take care of yourself first.
I see one from Natasha. I'm laid off at the moment, but my husband is continuing to work. Should she start the process and that add her income when she goes back to work? Well, there could be different scenarios here. The bottom line is, depending on how long of a gap there is in your employment, there are, you know, sometimes if it's more than 6 months, there's a requirement for that. Definitely they'll ask for an LOE. Are you going back to the same job you were? Are you getting a new job? It just kind of all depends on what the process is. Until you have a new job or actually go back to your old job, there's really not much you can do outside of maybe just getting pre-qualified or getting all of the documentation in place for your husband and your assets and everything to be able to provide to a loan officer. But until you actually start working again, you're more than likely going to have to wait to actually get a pre-approval.
Yeah, I'm seeing a few more questions about credit pulls. So, and the impact on your credit score. One of them was about, you know, how many mortgage loan officers should I have pull my credit? Each one is going to show up as an inquiry, a potential ding on the credit. Another one about let's see, where was that one? If the credit's bad and they pull credit, or if they pull credit and I think basically the gist is, what happens to your credit score when you pull credit, and how many loan officers should you let do that? Here's the thing. When you're shopping for a mortgage, you know, we can't answer with absolute clarity how credit scoring models work, other than to say, if you have an egregious number of credit pulls, then they're going to start to ding your credit, especially over a longer period of time and from more companies. But if you go look for a mortgage and within a week you have 3 different mortgage companies pull your credit, that's going to generally be treated by the credit scoring companies and models as, you know, you're looking for credit and you're shopping your best option, and they're not going to ding your credit each time significantly. Now you might see a couple points drop. You know, if you want to get 4, maybe even 5 loan officers, at that point I feel like you're probably getting a pretty comprehensive perspective. But and Tamara, chime in here too. I think it's fine to get maybe 2, 3, 4 loan officers pulling your credit so you can interview them, see what your options are, and go on from there. That's probably sufficient to get a feel for what your mortgage opportunity looks like, though. Tamara,
Right. Agreed. I mean, you know, 1, 2, maybe 3, but in also 2, if it's within a relatively small space of time, you know, that's viewed as you're out, you know, shopping and looking to purchase a home or something. That's better than if it's like over a couple just random searches over a couple different months. You know, the credit bureaus kind of look at that and say, okay, this person's shopping around. It's not something that's really going to hurt your credit score that much. But like Sean said, if you know, you got 50 people pulling your credit, then that's something that definitely can be an issue. I wanted to answer this other question here. If my car note is within 6 months of being paid off, will it be included in my income debt ratio? That's a really good question. And for it, from what the norm we see is, as far as the guidelines of Fannie Mae, Freddie Mac, FHA, the people who are out there that are going to either purchase the loans, or whoever the agency is, any installment loan, and that's important, installment loan, which means there is a set amount that you pay every single month. So, which is what cars usually are. So if it's within 6 months, typically what they look at is any installment loan that is going to be paid off within 10 months. Within 10 months, a lot of the time can be left off the debt to income ratio calculation. Now, the caveat to that is, if you've got one car loan and you got two people in there that are working, the question is going to be, if you pay that car loan off, what are you going to get rid of the car? Are you going to keep the car? Another thing is a lease. A lease is probably a bigger one. They figure, okay, once the lease is paid off, usually you typically have to give the car back. So while installment loans can a lot of times be deducted from debt to income ratio within 10 months of being paid, there are different things that could factor into that. So we can't for sure say yes, but with most within 6 months, a lot of times it can be deducted from your debt to income ratio. Talk to a lender and confirm that.
Yeah, and Tamara, there's a very closely related question here from Emmanuel. He's worried that paying off his car loan will negatively affect his credit. Couple things. One, keep making that payment. You have to keep making that payment, okay? Because you get a missed payment or something, that's an issue. However, and Emmanuel, this maybe one of two different things. Are you looking at paying it off because you've got the cash and you're paying it off in advance? Or are you saying that in the next few monthly payments, it will become paid off? For an installment loan like that, that's probably not really going to negatively impact your credit. That's an installment loan being paid on time and paid off as scheduled. And that's the kind of thing that credit scores model well. But Tamara, agree? Any other thoughts?
Yeah, no, I mean, if it's something that is showing is going to be paid off anyways, that shouldn't be something that negatively affects you. As far as, you're going to have that much extra that you can spend. So then they're also going to look at the fact that your total overall debt has now been reduced, which is also a positive thing. But if you just up and pay off something, close out something abruptly, that's kind of when they start looking at, it can hit your credit negatively. But if it's an installment loan like that and it's just through the process, then that shouldn't hurt you.
Yeah, and Emmanuel, consider this too. If you were in fact thinking of paying it off in advance with a lump sum, consider the value of that cash for your home purchase. And you might want to, definitely talk to a housing counselor or a loan officer, but you might want to hold on to that cash and apply it to the mortgage and then just keep going along with that car payment, and it'll be paid off soon enough. It depends on where you are, how many months are left. If you were paying in advance, then how much were you paying and how far in advance? Talk through that stuff with somebody, a loan officer or a counselor, but there could be different paths there. Let's see. Some of this stuff we've answered.
Sean, just a side point, as we're talking about that, as you get into, let's say you go to a loan officer and they pre-qual you or they do a pre-approval. A loan officer is probably going to say to you, let's say your DTI is too high, your debt to income ratio is too high. For the average down payment assistance program, you're going to see debt to income ratios of 43% to 50%. And let's say your debt to income ratio is 46 when it should be 43. They will go through and they will say, okay, if you pay this off or you pay this off or you pay this down, this can help lower how much debt you have. So a loan officer might go through and suggest things that you can do to help reduce your debt so that then it's something that will then be acceptable. So that could be an option, and maybe an underwriter will condition and say, okay, I'm going to approve this loan, but this has to be paid off at closing or when, whatever it could be, so that you are then under that ratio. So you might have times when a loan officer or an underwriter says, okay, this and this has to be paid off.
Yeah, this has bubbled up a couple times. We covered this earlier, but Teresa asked, what's the difference between pre-qualified and pre-approved? To boil it down, simply put, pre-qualified is kind of a cursory review of your financial situation. Pre-approval is what puts that letter in your hand from your loan officer that you can take to a realtor and now shop for homes. Pre-approval is credit pull, financial review, looking at income, tax returns, credit, and determining the specific mortgage product and interest rate and loan amount that you qualify for, taking that to the realtor. That's pre-approval. So you want to get to pre-approval before you start seriously shopping for homes. And the real estate agent you work with is probably going to want that pre-approval letter anyway. There's one here. This is interesting. So Tanya, she's been on the same job for 14 years, wanted to retire and start another that pays more. Is it better if she's thinking of purchasing next year, 2021? Is it better to stay on the current job? She's also trying to pay down some debt, and she thinks she can do better, I guess, employment-wise elsewhere. Hey, I think, Tamara, tell me if you agree. I think we would probably agree. Do what's best for you. It's okay to switch jobs. Do what's best for you, and that's not going to prevent you from qualifying for a mortgage. Certainly, if you're going to go make more money, right? I would reduce as much as possible the gap between two jobs. But other than that, I don't know, Tamara, anything else?
Yeah, if it's something that's going to put you in a better situation financially, then I don't see a problem with that. It's like Sean said, do what's best for you, and being in a better financial situation is only going to help you when you go to purchase a home.
Yeah, and we should probably, again, make the disclaimer. We said this up front. We are not a mortgage lender. We're also not financial advisors. We're not tax attorneys. So we're giving you our advice based on our many years of experience in the mortgage industry. For Tanya, talk to if you've got a financial advisor, maybe talk to them, maybe a CPA. There are other things that you would need to consider. You're talking about retirement. Is there a pension or 401k or IRA involved? There could be a lot of other things weaved in there. But generally speaking, switching jobs is not going to prevent you from qualifying for a mortgage. Certainly if there's no gap between the two jobs and if you're making more with the new job. Let's see.
There's a question here. I just lost it. Okay. Natasha, is it true that I need to be working for 2 years straight? Or if changing jobs, it has to be in the same field. If not, my income is not going to be counted. You do usually, you typically have to have a 2-year history of work. Okay. If there are gaps in that, it just depends on how long the gap is. Okay. And each agency has different conditions on that. But as far as it has to be, if you change jobs, it has to be in the same field. That's not necessarily the case. That's something that used to come up a lot. If you're a doctor and then you decide to go, work for Amazon as a stalker, stocking, then that's where, they're going to be looking at, obviously, your pay is going to be different and, things of that nature, but that's going to all be taken care of in your qualification. But it does not mean, I've seen many people that change their line of work and can show that they now in this line of work, they're making steady income. That's not something that's going to keep them from being able to qualify. So that's the trend I've seen. You don't necessarily have to stay in the same line of work. You don't necessarily have to be 2 years straight. It has to be a 2-year period, and it depends on why there were gaps, how long the gaps were, etc. So there isn't any one thing to say, this and this and this is going to keep you from getting a house. Talk to an LO and find out what the requirements are depending on the agency that you would be going through.
There's one here, going back to student loans. Millicent asks, I've talked to loan officers and real estate agents, and neither could help me relating to student loans. She's got good credit. She's also got money saved. It's hard to get a house. My credit is good. So what's going on with the student loans? First of all, are they being paid, and have you been paying them? Are they high balance, high monthly payment? Are they deferred currently? And if so, for how long? Are they in forbearance? And I think we need to cover forbearance too, related to the CARES Act. I saw a question about that. So Millicent, I would say, maybe get with a housing counselor and just go through the scenario, figure out where you stand with student loans. Look at what they think you ought to be doing in terms of student loans, but also your other debt. Compare it to your income. Look at a budget. Look at other expenses that could be cut back. Is there anything that's close to being paid off? Things like that. Without knowing where you stand with your student loans, are you at the front end or the tail end of repayment? Get with a housing counselor and review that scenario. A real estate agent is not really the person to be talking to with regard to student loans and their impact on a mortgage application. It would be good to maybe talk to one or two other loan officers, give them your scenario, maybe, put all the numbers together and say, here's my debt, here's my income, bring them some pay stubs. And they don't necessarily have to pull credit to have that conversation with you, but if they can help you out, they can earn your business and you guys can come up with a solution. Tamara, anything else to add there? And then I want to address the CARES Act and student loan forbearance.
No, I think you pretty much covered that.
Okay. So forbearance, somebody asked in here. So Mindy, I've read that the CARES Act student loan forbearance can affect qualifying for a mortgage. So let's touch on that. That's Mindy wanted us to address that. So unfortunately, I don't know that I have all of the facts in front of me regarding the impact. I do know that out of the CARES Act related to COVID, student loans were automatically put in forbearance. I'll tell you, I have one myself, and I continued to pay regardless of forbearance. I have heard that. Well, I don't have the facts. I don't know, Tamara, if you know more than I do. I'm nervous about providing an answer here because I'm not an expert.
I don't have enough information either to be able to answer that in an educated way.
Yeah, Mindy, I think the answer from us, and apologize for not being more specific, but we're not expert on this enough to give you a specific answer. Talk to a housing counselor, talk to a loan officer. If you've continued to make the payments, I think you probably would be okay. You could get that loan out of forbearance. If you've opted not to make payments, I honestly don't know. But a loan officer or housing counselor can help you. They're seeing that day in and day out right now.
There's a question here from, I'm sorry, were you done, Sean?
Yeah.
Okay, so Michael Lee, if you owe federal taxes or in a payment agreement, will that disqualify you for a mortgage? It doesn't show on your credit, but you're asking because we mentioned pulling tax transcripts. That's a great question, okay? If you owe federal taxes and you have a payment agreement, that does not mean it's going to disqualify you. That payment will be added to your debt to income ratio. And like you said, it doesn't show on your credit report. However, it could show up when taxes transcripts are being pulled. So they might have to be pulled a certain way for it to show up. But the bottom line is, as somebody's going through, the underwriter's going through your bank statements, they're going to see a payment every single month. They're going to ask about it. So best thing is, if you have a situation like that, be upfront about it. Make sure that it is added into your debt to income ratio so that it can be covered. You don't want something like that popping up halfway through and an underwriter's like, oh, by the way, let me ask about this. And now your debt to income ratio is too high. So it won't disqualify you, but you do want to definitely disclose it.
So we got several questions here. Natasha, Tamara, Sharon, I think. Gaps in employment. First of all, for those of you that have been impacted by COVID in any way, our best wishes to you and to your family. And I see a lot of you saying we've recently now started a new job. So Tamara, let's address as best we can a gap in employment, particularly COVID related. So let's see, in one example here, they were laid off in March, recently started a new job. Would they still qualify for a mortgage?
Your The answer is going to be, how much money are you now making at your new job? You know what I'm saying? They're going to ask for a letter of explanation why there is a gap, but they're more than likely going to want to see maybe, 3 or 4 pay stubs at this new job so that they have an idea of this is how much you're getting paid a month, and they can come up with a correct income. So it doesn't mean you now have to wait and be on that job for 2 years before you can get a loan. Not at all. You explain why there's a gap. It's just like anything. A lot of times mothers have a child and they go on family leave. And then when they decide to come back to work, they go get a different job. You just explain why you were out of work and then provide evidence of your new employment and the money that you're making. And like I said, they could want to see maybe up to 4 pay stubs or a month's worth, 30 days worth of pay stubs at your new job so that they can then qualify you the right way.
Yeah, and so there's a few other people that have some very similar questions here. If you're laid off at the moment and your spouse is still working, can your income be counted when you continue to work? Yeah, look, I think the simple answer here is, once you start working, they're probably going to want to see what they call seasoned employment. They're going to want to see a few pay stubs, make sure there's continuity with this new job, and get a feel for your income. If it fluctuates, if there's overtime, bonus, things like that. They're going to want to get a little bit of that. They're going to see a few pay stubs and see that, this job is going to continue on. But I think most importantly, don't delay having this conversation with a loan officer or housing counselor. You're asking the question now. You're on this webinar. You've expressed interest in home ownership. Keep going. We're looking at a slide here. We're answering questions while we're also telling you, keep going. Keep asking these questions. Get with a loan officer, discuss your scenario, and the answer might end up being, come back to me in 3 months, but do this in the meantime. Well, go do it, right? And then go come back to them in 3 months. But don't give up. Don't avoid trying because you've got this lingering question. Even if we couldn't get you the best answer or the perfect answer or the right answer, keep going. I think that's the theme with our answers here is, despite these scenarios, you're doing the right things. You kept looking for a job, you got a new one. I'm more than sorry that you had to experience a gap in employment, but don't give up. Please don't give up. All right, so I think we've answered a couple of these.
There's one here from Raymond. Do you foresee the California market downturning because of COVID, or do you see the market going strong? Oh, California. I just moved from California. So, as far as COVID goes, let me tell you what we're seeing across the nation. When all of this stuff first happened, we were all scared to death. We're like, oh my goodness, the real estate market's going to tank. We're all going to be out of jobs, right? And what we've seen actually is that the real estate market didn't get hit as hard as we thought it was. And what part did has rebounded very, very well. Now, the real estate market will continue to be one of the backbones of our economy. And when you're talking about the California real estate market, it's up and down all the time. Right now, though, with rates being as low as they are, just know that everybody's putting as much effort as they can into making buying a house very advantageous. So as I can't predict what the California market is going to do at any time. A lot of times it is a seller's market because of the nature of the beast. And right now it is more of a seller's market. But anytime you can get into a loan with a really low interest rate and with really good down payment assistance, that's going to carry you through the times when maybe it's going to be a little bit harder to get in. So that's my answer without really giving you an answer.
Yeah, and I'll add to that. A downturn is about values and prices, right? If you want to own your own home, buy the home, and then look, the market fluctuates. We go through pits and valleys, and maybe we see a downswing in values soon, but then it'll pick up, and who knows? We can't forecast that. And I don't know that anybody really can, but if you want to buy a home and be a homeowner, buy the home, and we'll all together as homeowners deal with whatever happens in the market after we purchase our home. Alicia replied back. She said she applied for a loan and they said reject the forbearance on the student loans, I think is what she's saying, and continue to make the payments. Alicia, I can tell you that's what I did. But, again, talk to a housing counselor, maybe a loan officer, figure out if that's the best deal for you. That may actually be closer to the real answer with regard to the CARES Act and the forbearance they applied to all student loans. However, it's not really our place to answer that specific question, but I'm not surprised to hear that, Alicia. If you can do that, if you can afford to make those payments and continue making them, it probably will help you. Let's see, a couple more in here, and then maybe we'll wrap this up. Lisa asks, do the same rules apply if you are purchasing a home in an organized community with their lenders? So I'm going to assume that means you're buying a new construction, newly built home, and you're working with one of their lender partners. I would say you choose who your lender is ultimately. You may go with their lender because they offer some special incentives. As far as the same rules applying, yeah, they're a mortgage lender. I mean, they don't have any, they're bound by the same rules. All mortgage lenders are bound by the same rules. So I'm not quite sure what you meant by that, Lisa, but Tamara, anything to add there?
No, you're right. They are bound by the same rules, but they may not have the same access to down payment assistance programs as other lenders, because that may not be something that they participate in. But do keep in mind, there are some huge incentives sometimes that go along with using a builder's using a lender that the builder wants you to use. So you kind of have to weigh your options and see what's going to work best for you. But they do have to abide by the same rules. They all have to be licensed the same way and everything.
All right, so we got one more here, and then I think we'll wrap this up. Michael asks, he's looking at retirement soon, going through divorce, child support's going to come up. Is this a good time to buy a home? He does have student loans. Yeah, look, none of that prevents you from buying a home. I guess maybe that's the simple answer is, yeah, absolutely. If, go figure out what you qualify for, talk to a loan officer. There's no reason you can't buy a home given any of those factors. None of them are a disqualifier. They just will have to be accounted for in the process of qualifying for a mortgage.
No, and the pending divorce, though, you have to keep in mind, depending what state you're in and the community property laws in that state, there could be documentation if you're trying to buy a house while you're still married, documentation that your spouse, in New York, okay, documentation that your spouse might have to sign, maybe a quitclaim deed or something like that. So just keep that in mind. A lot of people think their spouse is going to be their and soon to be ex is going to be okay to sign something, and then they get down to closing and guess what, now they don't want to sign, so there is different documentation and debt from that other spouse that you might have to take into account.
Yeah, so on that point, I see he's replying. So yeah, Michael, it sounds like you got this all pretty much worked out. Talk to a loan officer, make sure there's nothing funky that we're missing here, but maybe it's best for you to wait until that's finalized. Doesn't sound like there's anything disqualifying you from going through a home purchase, though. So keep going, explore the option. All right, guys. With that, we have, I think, answered everybody's questions that has submitted them, or at least we've tried. So we're going to go ahead and wrap this up. I'll keep our info up on the screen here. Listen, you're here today because you're exploring home ownership. You've gotten this far. You've taken a lot of steps. A lot of you are dealing with some things that you need to work through, but you're doing it. You're doing it. So I'll end this, and then I'll give Tamara a chance to chime in. I'll end with, keep going. Good luck. You're here for the right reasons. Don't give up now, and don't delay. Even if you have questions, go ask them. Go talk to a loan officer or housing counselor. Ask your questions and figure out the solutions. Don't sit around and wait, because guess what? Prices are going to go up. Interest rates are going to go up. You're going to have to save for longer. You're going to have to renew a lease. Just keep going, guys. Keep going. Get to your home purchase. Tamara, any final words?
Just along with that, you know, this is going to be one of the probably the most important purchase you ever make. And, you know, and it is a very good purchase. It's getting that part of the American dream that we all want. So don't listen to he said, she said. Don't, you know, don't always automatically, if a friend says this or says that, don't automatically think that's the way it's going to be. Take that step and talk to a home counselor, talk to a loan officer, find out for yourself, and talk to more than one loan officer, okay? Because this is you, this is yours, this is something that is going to make you stronger and kind of cement you into being a homeowner. So take the steps that you need to take, and don't let anybody try to discourage you from doing what you want to do. Definitely go for it.
All right, guys. Thank you. Have a great weekend. Continue your journey. Join us for our next series.